Welcome back, everybody. And yes, this is a day late. And yes, well, other things came up that were a little bit more important. So I had to take care of mom. And everybody's got to take care of mom. And so, well, I'm a little day late, but that's all right. So with that being said, let's talk a little bit about what the heck has changed. Not so much change, but what affects mortgage rates and what affects real estate, because the number one thing that affects real estate right now are mortgage rates. And what affects mortgage rates is directly proportional to what's happening with the buyer activity out there. So let's get this show rolling. Let's talk a little bit about the mortgage side of things so you guys kind of understand what's been happening, what's expected, and what should we be looking for. Then we're going to dive right into the real estate markets and trends and where we're at. And yes, we're actually doing all things considered very well. So let's go ahead and bring up our first slide here. So mortgage apps rise 8%, and volume of as far as actual purchases has actually softened just a little bit. You can see that when we take a look at the fund, it's almost at 7% again because it bopped up a little bit. Not uncommon because of some of the things that are happening out there in the industry. Now listen, when we take a look at what's going to affect what mortgage rates do, because the feds don't control long-term mortgage rates. They can have an effect on them, but they don't control them. The feds control your car loan, your home equity line of credit, what banks lend to back and forth, commercial loans, which is a big sticking point when we talk about real estate and banks being solvent, because they have some very big obligations, about $1.3 trillion of commercial refinances that need to happen this year. And as you know, with the feds increasing basically from, just above 0 to, 5%, that actually has a massive impact on things. Anyway, so let's move on. When we take a look at this trend, look at this chart. Okay, this is super cool. When you look at this chart, this talks about the 30-year fixed rate index with Freddie Mac. Freddie Mac is one of the metrics that we look at each and every week. And as you can see there, October 16th, we were at our peak. And then, of course, as we drop down through November, December, into February, where we're starting to creep up just ever so lightly, right? And then we pop over, and then we take a look at this, and we say, okay, so now we have our price index, which then when we take a look at CPI, and CPI numbers are scheduled to come out. So if CPI numbers are below 3% or 0.3%, we're probably going to stay about the same. If it goes down to 0.2%, we will actually see an improvement on mortgage rates. However, if we see the 0.4%, more than likely people are going to have problems with the bonds, are going to move over, and that's going to have a volatile effect on mortgage rates, because remember, they're publicly traded. Look at your 10-year treasury. It's not part of the 10-year treasury. It's a good metric to follow, but look at your bonds, look at your mortgage-backed securities. Those things will tell you what to expect with mortgage rates. All right. So when we pop over and we take a look at this, you need to make sure that you like, subscribe, and share if you like this information. Hey, listen, it just tells us we're doing a good job and it helps others. All right, moving on. Look at Freddie Mac. Let's blow this back up again. So Freddie Mac, which like us uses a running 7-day average, but there's lags just a tad bit. You can see that it's 6.64%. It's actually just a tad bit higher. It'll probably come back down because we, again, should be getting, I believe it's this week or early next week. I believe it's this week we're going to get the CPI numbers, and that is going to be a big deal. What's going to be super important for you is to make sure that you are looking at that video. And again, we'll put that link there. Look, it's free. It doesn't get any better than that. It's free. It's a It's a video that walks you through the 5 most critical things you need to know when getting quoted mortgage rate. Listen, okay, here's the funny thing. All right. Well, I'm not sure it's so funny. So I had a client call me like, George, you're not going to believe this. I can get a loan at 6.3%. That is better by half a point than everybody else is offering today. And I'm like, really? That seems a little low. That sounds like marketing. What the heck? And so he sent me to the site and I looked at it and I went, oh my gosh, dude, go watch the video. Listen, first, they only allow you a $380,000 loan amount. And the home has to have a value of no less than $500,000. Dude, that's $120,000 you got to put down. What? Plus, you have to have 780 credit scores. Okay, so I have to have super high credit scores. Okay, but I can only have a loan balance of $380,000. Look, the mean property, the medium value of a home in our areas is over $780,000. That's well above that. So that means you'd have to put gobs and gobs of money down. Listen, watch that video. It's free. It is super important. It will give you some really great insights. Moving on. All right. So when we pop this thing back up here and we take a look at our next slide, here we go. That is a mortgage calculator. This, again, will be made available for you so you can go and take a look at it. It's free. What's the benefit? Look, you can compare. You can compare 4 different mortgages at one time. And if you have hey, should I refinance? Look, there's a free refinance calculator there for you. It's super simple. There is a calculator that allows you to do 1 mortgage, but it's always nice to take the quotes, put them side by side, and do a report and see which one makes the greatest amount of sense for you. And it's free. Here's the super cool part. If you have a question about it, you can actually say, send this to George for comment. Well, something like that. And it'll send it to me and I can take a look at it and help you understand. Look, there's no cost. I don't do mortgages. But it will help you understand and make a better business decision. Moving on. All right. So when we take a look at this next slide, we talk about the real estate as far as what's going on in the Northwest MLS.
Okay, so a lot of people say that we've got a pretty positive market, and I tend to agree with that. There are the naysayers out there, but let's take a look at our running 7-day average here, right? So we've had 792 homes that came on market, okay? And then we had 1,116 that went pended or off market. So we're still seeing more homes going off market than we are seeing on market as we draw down our inventory. And we're going to see those numbers here in just a little bit. We have 585 closings, and we will start to see that ramp up, that will start to match our pended homes, although we did see 92 homes that came back on market where the seller lost their buyer.
All right. Now, if we take a look at, and some people say, you know what, George? Is the market really that good? Are we really doing that well? Well, the answer is yes. And one of the things that we're one of the top 5 markets throughout the United States, and we're considered the sweet spot. All right. I just wanted to be sweet, so I could be sweet spot. Anyway, with that, let's take a look at something that is super cool. This is actually put out by the Federal Reserve. And it's an interactive map, and let's take you through this really fast. This is super cool because it's going to talk about, or it's going to show you, I should say, what some of the appreciations are that we're seeing month over month and year over year, and all that happy stuff. Hang on a second.
All right, so we have the Federal Reserve Bank of New York, and this is an interactive map. So what they're looking at are the mapping changes because our December 23 numbers are in. Basically, what did numbers do? So when we come down here, we can see that if we watch, this is the United States average, and then this will be the county. So you can see Snohomish County is up 5.9%. Okay, that's awesome. Down here, King County was up 4.4%. We've got Skagit at just under 1%, Whatcom at 4.9. Then when we have the brown over here, I guess tan maybe, you can see that those were areas that went down a little bit. Brown, Kittitas, they took a pretty pretty healthy beating at almost 19%. However is the core areas, as you can see, like here when we have King County, and then of course we dump down into Pierce at 4.4. When we hit Lewis, actually if we hit Thurston, 4.7, and then 3% for Lewis, you can see that we actually have done relatively well.
All right, now let's take a little bit of a deeper dive. Let's go and just delve right back into the MLS, although I will put that link there. I think that is a super cool link for you guys. It's just fun because it'll take you back a lot of years and you can see how things change on a monthly basis. And in fact, it's super cool to see, what happened through 2008 through about 2014. Then the first-time buyers and industrial buyers came in and did some absolute massive, buy-ups and absolutely dropping our inventory down. And you see those double digits, continue to progress. So super interesting, but I thought you would enjoy at least that little interactive map. All right, moving on. When we take a look at this, so one of the key metrics that we look at is the average active price, meaning that a home that is active versus the one that is sold. Let's open this up. Let's go through this one real fast. Hang on.
When we take a look at the year-to-date for active average prices, meaning the average price for homes actively available for sale versus the average sold price. So the green is for sale and the red is sold. And you can see from back here in November of 2022, you can see how we do our what we call historical up and then back down for the winter and whatnot. Totally common. Note that the active is definitely a little bit higher when we talk about the loop, and it is the average of the two. So again, the upper line will be the active average price, and the average sold price is on the bottom. And so when we come over and we take a look at just February over February of 2023 and 2024, you can see that both the active average price is up about 2.5%, just a nominal amount, about, what is that, $24,000. And we have a slightly higher sold price, which is, let's just call it $39,000, higher year over year. Now, when we take a look at year to date, you can see here that we're again up 2.5% on the active price and 7.2% year to date as far as a sold price. So all of our numbers are showing that we're heading in a positive trend, with the biggest factor being interest rates.
All right. Now, as you take a look at those numbers, you can see that we've been heading in a positive trend. Will that continue to happen? Look, mortgage rates are going to have a massive impact on that as long as we are staying below 7%, really between, it would be nice, no higher than 6.6, but bumping up to the maximum of about 6.8. We will continue to see buyer activity, and we're seeing sellers come on. Yes, we've seen some early spring activity, earlier than spring activity. Here's the thing, though, super important as we are looking at and kind of projecting what we're going to see in the future, like mortgage rates this week. As soon as CPI numbers come out, super interesting to see what shakes out. With here, that is going to have a direct relationship on buyer input. The one area that the buyers are a little bit more aggressive on is new construction. We'll get there in just a little bit. So let's move over. So look at this. So when we take a look at our quote unquote Northwest MLS, looking at residential only, you can see that our inventory on the right hand side there is down 8.6%. Super crazy. Actually, let's do this. Hang on. Let me scroll this back. Let me dial this in a little bit tighter for you.
So when we take a look at our year over year for the Northwest MLS, we can see that the inventory again is dropping down. Naturally, our new on market is down, but not quite as much, and the disparity is not even 100 homes. When we look here, we can see that we're down 3.9, basically 4% on solds that have closed. And again, we're looking at 4.3% less on pended. What's super important to understand is these numbers actually are still pretty small. That we didn't see the big disparity like what we saw last year. So when we compare that against the February of 2024 versus February 2023, again, you can see that all of our numbers are quote unquote in the downward trend. When we look at it, so pended, we're off about 53 homes, sold off about 156. When we take a look at the new on market, we're down 82, and then inventory available is down 549. Part of that, again, is because we are drawing off more homes every single week, drawing off more homes than what come on market.
All right, now let's take that, and we said we were going to talk about new construction, and then we're going to talk about the REOs, or the bank-owned foreclosure side of things. Let's roll over and take a look at our new construction chart. Let's blow this up. Hang on, let's blow this up and take a look at that.
Now, just like last year, new construction is actually down a little bit as far as inventory and new on market. But as you can see, they're actually up when we look at pended sales and closings. You can see that we're a little bit higher. And so that's really great news, because with all of the incentives, we're still seeing a lot of velocity with new construction going off market.
Super crazy how some of those numbers are working out. Let's delve into bank-owned. Now, understand, bank-owned, even today, so there's one bank-owned condo that's out there, and we actually had an inquiry, and they said, George, is that condo really 300 and I think it was like 75,000 in Bellevue, 2-bedroom, 1 bath? I'm like, it is. What's the takeaway? Well, the takeaway is the fact that they did quite a few capital improvements, and the homeowner's dues are $975 a month, which is crazy insane. So that is super steep. Plus, this bank, which happens to be a VA bank-owned home, you also have to pick up title insurance, their side of escrow. So you're going to pay, if you're financing, you're going to pay title twice, because normally the seller pays for it once. Plus your escrow fees and other recording fees, because, well, VA doesn't pick those up. That's kind of unique to them, whereas the other organizations, like Fannie, Freddie, HUD, USDA, they pay their own customary fees, but not VA. Well, who knew? Anyway, well, I guess I knew. Anyway, moving on. Let's move this chart along, and let's take a look. Let's zoom in on our bank-owned here.
So take a look at this. So again, we do have our wall of shame, but when we take a look at it from year to date from last year, so we're only up 20 homes as far as existing, bank-owned homes. Here we're up 16, homes that are newer, and actually this is a little bit less, all funny things considered. And then 9, and then 8. Even though over here, it says, hey, our solds are up, almost 53%. That's 9 homes. When you're dealing with such tiny little numbers, naturally that has a big play in things. Now, when we take that, let's say we compare it down, say look at February and February. Okay, so what we have are 20 more homes. It's actually, less than what they have there. And then, of course, we're only 3 more new active. Now, that's pretty much small potatoes, even though it says we're up 71%. Some of these are not real REOs. They're actually normal sellers with listing agents, being part of that wall of shame. Then down here, look, we're down 1 home, but it says, hey, we're down 25%. But okay, so yeah, all right, it's 1 home. And then of course on pended, look, we're up 2 pended sales, which says, hey, gosh, you're up, 33%. Well, okay, that's 2 homes. So again, when you're dealing with super tiny numbers, that is what happens. So again, our REO inventory and everything else, it's super small, peanuts, not a big deal.
All right. Now, just understand our market, all things considered, is doing really well. So for the naysayers out there, keep saying it because, eventually, sometime, somehow, it will be coming to fruition. You've been saying this since 2020 that everything was going to crash and burn. We did not say that. Go back and watch our videos and you'll hear that I said that will not happen. In fact, we'll continue to be aggressive. And our prediction for everything is super, super accurate. So when you take a look at it and if you want super accurate information, listen, look, all we ask you to like, subscribe, just let us know what you're asking, or I guess you would let us know if you asked a question. Anyway, ask questions. We love to answer them. There's no strings attached. In the meantime, have an absolutely beautiful day, and I will see you on the next video. Take care.